Hello, everyone. Today, as requested by many of you, I'm going to walk through exactly how I trade. Now, in order to do that, I do need to just do a little bit of theory as to what we used to do when I worked at banks, because I was a trader for banks for many, many, many years and have performed these transactions thousands and thousands of times. And to really understand what goes on at a bank, I'm just going to quickly walk you through how a day would go. And stick with me, I'm sure it'll make sense um, once you understand what it is we were trying to achieve and how we got paid. And then we'll go through a chart and I'll show you exactly what we were looking for and exactly why price does what it does. I'd strongly encourage you to all try this out. And if you think I'm wrong, let me know. I'll gladly debate anybody on this topic any day of the week. I know there's a lot of nonsense that goes on in the Forex market. So hopefully we can put this to bed once and for all and hopefully get you guys profitable by the end of the week. So how would our days go at the bank? Let's say a big bank like HSBC. Well, we go into the office, and about every 4 hours or so, we'd go in for a briefing. And in that briefing, the people who would be involved would be the boffins and the analysts, and they'd be looking at data like this, much more complicated. They'd have algorithms, they'd have a whole host of things, and they would really, their objective was to forecast a range for the next few hours of the market. So, for example, they might say, we expect the Australian dollar to trade between 70 cents and 70.25 for the next 4 hours. And we would understand that that's the operating range we'd be looking at. And then the sales guys would go out and they'd start contacting their large clients. Now, let's say, for example, one of our large clients was Toyota. And Toyota is making a lot of sales in a country like Australia, and they need to remit funds back to Japan because they're about to, tie up their financials and those sorts of things. Well, our sales guys would call the CFO and they'd say, look, here's the target range we expect the yen to trade in. Do you want us to start remitting those funds? And the CFO would look at his calculations and projections and say, yes, that all aligns with everything we need to do. We've got a few $1 billion we'd like to send back. Please send it back. The sales guys would sit there and come out to the trading floor and say, yes, we've got the orders, execute within this target range for these clients. And it wouldn't just be Toyota, there'd be, hundreds and hundreds of clients. And as traders, we weren't trying to hunt people's stop losses. We didn't care whether the price went up or the price went down. We didn't care whether there was a spike or anything. Our sole objective was to make sure that we got Toyota's funds back to their country within the targeted range that our salespeople had negotiated and our analysts had told us the range should fall within. Right? That was our objective. To move $3 billion, we'd typically charge a fee of around $3 million and we'd get paid an awful lot of money. That's why bankers get paid big bonuses, not for being good traders. I mean, most of the guys there had no clue. I mean, let me ask you this. If all banks knew how to trade, right? Why would they not just trade themselves? They don't. They sit there and they teach people how to push buttons when a price is in a certain range. It's that simple. Okay. So once I'd received that order, every time the price hit within the bands that I was permitted to trade within, I would start executing. Okay. And I wouldn't execute, on a MetaTrader 4 platform or anything like that. I would execute to the other interbanks. So let's say you've got Citibank in New York, and Citibank has a slightly different range, but they're trying to do the same thing. They're trying to keep price in their range so they can execute their client transactions and get their bonuses. And we were trying to keep it in our band to execute for our clients. That's as competitive as it got. Okay. There's no, oh, I'm the world's greatest trader, check out my Lambo. It's no, I'm the person with the best ability to execute transactions within this range. Now, that sounds very boring, but next time people talk about changes, structures, and all liquidity gaps, it's all nonsense, I assure you. All we were trying to do is make sure we got our bonuses. The reason politicians and bankers have great relationships is because all they're trying to do is keep world economies ticking over as effectively as possible. Okay, no one else cares about stop losses or anything like that. We're trying to simply remit money from one country to another country within a specified band, and we get paid very well for it. And we used to do it thousands and thousands and thousands of times a day. Now, that's good news for us because it means that once we understand that core philosophy, we can get rid of all the psychological issues and we can determine where the price is going, or not where the price is going. We can determine whether the market's in an efficient range or whether it's in expansion range, whether it's going from HSBC's band to Citibank's range or Citibank's to Goldman's and the like. And the way we do that is by looking at charts a little bit differently than most people would. Typically, when you're at the bank, you have a DOM terminal, so you can see orders running up and running down. But as retail traders, we don't really have that. But there is a way we can basically determine whether price is efficient or not, simply by using candlesticks. Now, the trick is, and I'm sure people have never told you to do this, is we are only interested in the black candles or the down candles, okay? The reason being is by only looking at half the structure of the candles, we can determine whether the price is being delivered equally on both sides of the range or it's expanding to a different part of the range. So let's go through this. It'll take a little bit of practice, and if anybody's got any questions, I think you all have my contact details. Just reach out. I'm more than happy to help. But here we have the open. Okay. Oh, and two other things. Number one, I only want you to focus on US dollar pairs, and the reason for that is because most trades done in US dollars, and secondly, every other price is derivative of US dollar. And what do I mean by that? You probably all know this, but the Australian dollar Japanese yen, for example, is just a byproduct of the Australian dollar US dollar and the US dollar Japanese yen. Okay, so to check the efficiency of a market, you're better off starting with the Australian dollar because you know that everything is priced off that. So if the Australian dollar, US dollar is moving to a certain range, you know what's going to basically happen with the Australian dollar Japanese yen. So anyway, let's get started. Here we have a downward candle, right? We're only focused on the down candles. So first candle, we'll mark that off. And we're only going to focus on the bodies. Here's another big tip. Only worry about the bodies. Wicks are for fools. Bodies is where the real action happens. We're only operating on the 5-minute chart or less. There is ways to do this with the longer term stuff, which I'll go through at a later date. But this is just the quickest way for you to read a chart and start to become profitable from today. So we mark off that black candle. Here we have a black candle. Here we have a black candle. This is market open, obviously. And you can see that the black candle's coming back and trying to test this black candle. The body didn't confirm it. So what we consider is that this market is inefficient. As we start to break up, we wouldn't really be doing too much here unless we were manipulating price. We start to look for where the next black candles are. Okay, now this particular black candle pushed down. Now, this is where it gets a little bit interesting. We're going to mark this little candle up right here. The reason we're going to mark that candle off is because here we had a push up, here we had a rejection of that and a push down. Now, this upward candle tried to come up and reach into the first body of this black candle. However, it couldn't do it, okay? It tried and it failed. So this is where it gets interesting. I'm here to tell you right now that because this candle failed, this candle here, once it breaks this candle, is going to go down. And where's it going to go down to? It's going to come down to this open black candle. No black candle body could form or could reach into this black body's candle. So here you would say, I'll place my stop at the top of this candle. Here I could see that the market became inefficient because it had a push up, but it couldn't reach up into the body of this candle, and we're going to continue on. Specifically, we're going to come back to this particular black candle. Okay, now don't worry, we're going to go through and make some more examples here, and look, later in the week we might do some live sessions, or we might just do some back testing, but it won't take too long for you to get the hang of it. So let's get rid of this line now. So because this has come back to this particular candle, that move is complete. Okay, so as an interbank, I could have put my orders out, put them back in, balance my book. I'm on a net zero position. I've executed for my client. Everybody's happy. I wouldn't have done the whole 3 billion during that phase, but I would have probably got a few 100 million away. So here we have a black candle. We have a push up. Now, here we have the black candle after the last push up. So we'll mark that off. This will be a target for us at a later date. Here we have another push down and we have a push up. So think of this as like a line of defense. Here, Citibank's trying to basically get their price back up to their target because that's essentially what they're trying to achieve, but they can't do it. Now, they're not going to throw money at it. They're just going to sit there and wait. Okay. So we have push up, fail, push down, body of this candle comes back into this black candle. So we're efficient. Here we have a push up. Notice that we've had a change. So we've had our white candles, but we still haven't had one of the bodies within the bodies of the candle. And because of that, guess what? It's inefficient. So we come up exactly to that point. And I'm not so worried about the wicks. I'm worried about the bodies. Here we have a push up and we have a black candle. And we're going to break that. And when we break that, we're going to come all the way down here. So here is where we would be entering. And we know that we've failed in our attempt to balance the books. And we'd probably pick up 14 or 15 pips. Happy days. So what happens then? Here we have push up, push down, body into body. Everything in this zone is efficient. Okay, so here's where a lot of business is taking place, and we can do it with a little bit of comfort. And we have a black candle to the bottom, and as you can see, we push up. Where does this get interesting for us? So here we have a black candle. So we had a lot of sellers coming into the market. Now, where would we expect this to come down to if this was an efficient market? Well, here's the last black candle. Here's the current black candle. So we would expect in an efficient market, the body of this candle to come into the body of this candle. But look what happens on the next candle. It doesn't occur. So let's mark this off. So body here, black candle, body here, this body can't get within this body. At the point this candle breaks, okay, we've had a failed attempt. This is going to continue up. Now, where do you think this is going to continue up to? Right here. That move is now closed. So this move to this move has now closed. Okay. So at the break of this candle, we can buy knowing with a great deal of certainty that this candle here is not going to get breached until we get to the top of this range, the start of this move. Okay, amazing, isn't it? So let's continue on through the day, and you can try this on any US dollar pair on any day. I know that this is probably the first instructional video, so a lot of people will think, oh, he's just cherry picking. Well, I'm just using yesterday, but you can use any day you like. Okay, so we've still got a zone that's uncovered here. What have we got here? We have a pushback down, a pushback down, a pushback down. Where can we get into? Guess what? We still can't get past this candle. We still can't get a body close of a black candle into here. So what happens? We push up just a little bit. Now, that doesn't seem like a lot, but let's say at the breach of this candle, you just took a quick 10 pips. I know plenty of traders that would like to take 10 pips. And you know, as I say, that this candle here isn't going to break. So it gives you a fair bit of certainty. So here we go, meandering on. Now, here we have the first change of color. We're only focused on the black. Here we have a black candle. So let's mark off the bottom of this candle. Now again, what will we expect to see? We will expect to see a challenge of this candle. And here we see it. We have a push up and we see the market trying to get back to make this efficient. We want the books balanced, everybody to be able to sit there and get their orders off. We're not competing with each other. We're just all trying to get our trades away for our clients. Here we fail. Okay, we've had a push up, push up, push up, and a fail. So again, on the break of this candle, we know that the price is going to continue down. Where would we put our stops? Well, we'd put our stops there. Tiny stops, look. 7 pips. Now, where do we think the price is going to go down to? And let's be very, very, very specific. Is this still uncovered? We only have two options. The price is either going to breach this candle and go up to this point here, which is our first area of inefficiency, or it's going to come down here, which is our second point of inefficiency. We could see we had a failed attempt, and so where do we push down to? And look at that, to the pip. And it's not 10 pips through or anything like that. It's pretty much to the pip. So that's great. We've now got this efficiency getting tapped. We still haven't had a real good body close through it, so we'll still leave it there. So then what happens? Well, at this point, we've taken our profit. Here we see a push down, okay, and we see an attempt to stage a rally. Where does this price go back to? Right to this line. Where would we know exactly that this was the area that we were going to go towards? Well, here you have your black candles, okay? Here you have your attempt to come back into this range. So let's mark off the top of the body of the first candle. Now, this attempt, this black candle here, could not come down and enter the body of the first black candle here, right? It couldn't do it. It tried, it failed. So at the break of this candle, where's the price going to go to? And you know this with certainty. You now know that this particular candle is where the market is going to tee off from. It's not going to break that candle. It had a failed attempt and it didn't work out. And where's the price going to go back to? Look at that. It's going to come straight back into the body of this candle. Okay? Then we're going to fall. So I should say at this point we don't know it's going to fall, but let's have a look and see what happens. So then we come all the way down. Sell, 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 sell. Nothing for us to do here. All right, it's coming down. It's clearing out all the zones, but here we're going to mark the body of this black candle, and we're going to see how efficient things are. We are also going to mark the bottom of this particular candle. And the reason we are going to do that is because it's the start of the range, probably Goldman Sachs range, and they're probably trying to do some sales for Nabisco or something. Who knows? Who cares? We're just worried about Toyota at the moment. Our price comes down. We have a black candle. We're marking that off. We push up. Now, in order to push up, we've got to push all the way up to this point here. And this was a failed attempt to do so. Price comes down, price comes down, price comes down, price comes down. Look at that. We're bouncing off the top, but we still haven't really had a body close into it, have we? We push up, we push up, we push up, we push down, we push down, we push down. Look at that. Now we have had a body close within the body of a black candle. So what do we know? This particular book or this particular move has now been balanced. Okay, so that's great for us. We can start teeing off our trades again. We can start executing for our good friends at Toyota. And let's have a look here. What would tell us that the market is going to move up? Here we have a bit of a range. We'll go into this in more detail at a later date. But here we have our black candle. Where's our next black candle? Our next black candle is here. Our black candle tried to come down, tried to fit into the body of this black candle. However, it could not. All right, couldn't even come close. So this is the start of the move. So we can mark that candle off. At this point, once we have a break of this particular black candle, we know that we're going to start pushing right up. Okay, so we push up, we push up. Here we have another failed attempt. So we can mark that up. We have a body attempt here and we succeed. We have another body attempt here and we succeed. So that's starting to tell us that this particular move has run its course. What happens then? We come down, we break this particular structure. And this is just happening all day, every day. Here we have an attempt to push up into the body of this candle, but we fail. Where do we come back down to? We come back to the start of the move. Notice that the body still could not close within the body of this range. Okay, so as we push up, we know with great effect that this particular candle has now become a real resistance. And at the break of this candle, we can start taking this trade up. Now, with this particular trade, you'd have your stop loss here, basically 6 pips. I'd only be taking it really to the top of this range, but realistically, that's still a 2-to-1 risk reward. The reality of the move is, where do we think it's coming to? Okay, so once we've cleared that out, we can see that we're going straight back up. Where do we run into issues? Well, where did this move start from? Here. What happens when we get to this range? We sit there and we have an indecision point. What's the only range that hasn't been taken out? All right, let's zoom out a little bit. Let's have a look at the day. Where did we start the day? Where did we say this was going to range towards? Well, we're going to come right back up here. And that essentially gets everybody squared away for the day. So what I want you guys to focus on is simply marking off black candles, all right? And see if a black candle's body can close within the body of the previous black candle. If it cannot, the market will continue in the direction it was meant to be. So as I say, see here see this black candle could not finish in the body of this black candle. Well, that's going up because it couldn't close to the upside. A break of that candle means you're going to get a run up. As you can see right from the start of the day, this failed attempt of any of these candles to finish within the body of the start of the move signifies that it's going to go down. Same with here. And at the end of the day, the market's going to go right back up to fill the ranges of each market. Now, I did a more detailed video on this, and I know this is a little bit complicated as it's a new concept, but again, just focus on the black candles today and tomorrow and for the rest of the week. And I'm pretty sure if you just mark those off, you're going to see exactly the ranges of the markets. Okay, exactly when to take a trade, exactly when a candle is going to break and when it's not going to break. I'll try to keep this as short and sweet as possible, and I'll try to keep it as simple as possible. Trust me, there's hours and hours and hours of theory that we could go into, but for the purpose of this exercise, we just want to get you guys making money as quickly as possible. So do me a favor, go on, like and subscribe the video, leave some comments. Everybody knows how to contact me directly if you're watching this video. So if you've got any questions, just shout out, ask, we'll go through it. Throughout the progression of what we're trying to achieve here, we'll probably go on and do a lot more detailed stuff over the coming weeks, and probably some live sessions as well, so we can all sit there and really start to see exactly what's going on with the market. Look at all US dollar pairs, start with those. Don't do it on the hour or anything like that. Start on the really short time frames, because even if the reason we're not doing the 1 minute is because you've got broker issues with a lot of you guys. A lot of you guys are on prop firms. 5 minutes should give us enough leeway to make sure that we can still see all the moves without giving up too much inaccuracy to broker data issues. So look, guys, I hope this has been helpful for you. Again, shout out with any questions or comments. And yeah, I think if you follow this particular methodology and you understand what the banks are trying to achieve, you stop worrying about evil brokers trying to take you out. It's just nonsense. It's not at all what bankers are trying to do. And if you do that, all of a sudden you're going to see the market with a lot more clarity. And you'll also be able to take trades with real certainty. I mean, if you're not taking a setup like that, once you see the break, you know, the stop losses are tiny, the rewards are huge. And look, if you get one wrong, it doesn't really matter because the trades you'll be taking are going to have very short stops and very decent take profits. And it's rinse and repeat. Doesn't matter what the economy does, doesn't matter if market changes. The only thing that would ever upset this market is if world commerce came to a global halt. And until that day, there's money in there for everybody to make. Doesn't matter if everybody's doing it. There's no edge that you have to protect. It's basically, what do we think Citi's orders are? What do we think Goldman Sachs's orders are? Have they triggered a run? Have they not triggered a run? How do we know that? Well, we know that by looking at black candle to black candle. Anyway, guys, hope that makes sense. I'll wrap it up. Thanks so much for your time. And yeah, I'll probably send out some signals today. Thanks, guys.